amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Now let's take a look at what happened last week. Major U.S. equity indexes ascended to a fresh weekly closing high as signs of economic strength and positive corporate earnings reports overshadowed the increased pressure from the White House on Federal Reserve Chair Powell. The NASDAQ composite gained 1.5%, while the S&P 500 and Russell 2000 added less than 1%. S&P 500 sector performance was mixed. Technology jumped 2% after key supplier Taiwan Semiconductor reported strong Q2 earnings, while energy slid 3.5%, along with crude oil prices. Financials advanced after the large U.S. banks posted Q2 profits that jumped more than 20% year over year. In crypto news, the U.S. House passed the Genius Act, a bill creating a stablecoin regulatory framework, along with two other bills that could lead to a wider adoption of digital assets. Bitcoin prices ended up slightly lower for the week, but Ethereum soared nearly 20% as inflows to exchange-traded products that track the second largest digital currency spiked to record highs. U.S. Treasury yields began to climb following Tuesday's CPI report, which revealed an uptick in consumer prices for June. And higher food and energy prices pushed CPI up to 0.3% month over month and 2.7% year over year, largely in line with forecasts. Longer-term Treasury yields jumped midweek and the dollar plunged after reports emerged that President Trump was strongly considering replacing Fed Chair Powell. Although stocks pared losses after the president said the move was highly unlikely, investors may remain cautious given the administration's increasing pressure to lower rates, which is an improbable outcome from the next FOMC meeting in July. In other economic news, U.S. retail sales rebounded last month, although these figures are not adjusted for inflation. Consumer sentiment lifted this month, buoyed by an improving economic outlook and softening inflation expectations. Manufacturing activity expanded in the New York and Philadelphia regions, while price pressures remained elevated. The housing sector continued to suffer from high mortgage rates, with single-family starts and permits falling sharply in June. The supply of new homes rose to levels last seen in late 2007. Overseas, China's economy grew in Q2, slowing in the previous quarter. Industrial production accelerated year over year in June, while retail sales growth eased from 4.8% to 6.4%. Property investment sagged despite multiple rounds of stimulus support, and new home prices tumbled last month. And China ended the first half of 2025 with a record trade surplus as firms were able to increase sales to other markets to compensate for reduced U.S. trade. UK CPI unexpectedly ticked up to 3.6% in June, the highest rate for any advanced economy. Economists still expect the Bank of England to cut rates next month as the labor market has continued to cool. Now let's get going into our content for this week. So a huge week. We've had a couple of weeks off as this studio has prepared to launch in timely fashion into a video cast next month and to launch the Life Cycle of Wealth book, republish that's been overdue now since 2019, let's say. That's the last effort at the book, republished. So those are big things going on here at A Steward's View in the past 2 weeks. We did release what I'm kind of renaming the Stewardism series or the Living Stewardship series with Paul Larson in the last 2 weeks, once per week. However, this standard program based in economics, investments, and planning has been on pause while we've been doing these other things. So I'm really excited to be back. It was a huge week last week, and I won't try to unpack all of that as usual, but I do want to talk about what happened on July 4th. So on July 4th, one big beautiful bill act was passed. The OBBBA was signed into law July 4th. And I want to talk about what's in it, and then I want to talk about a little bit of the impact of it in the second segment, right? So for the moment, we're just going to look at what it is, and then in the second segment, we'll come back and kind of look at potential impact, I'll call it, okay? So the OBBBA, key provisions of this thing, in terms of taxes and credits, it makes the 2017 Tax Cuts and Jobs Act permanent, extending individual tax brackets and corporate cuts. It also takes the child tax credit and raises it from $2,200 to $2,500 per child. That's children under age 17, and then indexes that number to inflation. Regarding tip and overtime deductions, workers can deduct up to $12,500 for an individual or $25,000 jointly for tip or overtime income, either one, from 2025 to 2028. There's an auto loan interest deduction now up to $10,000 per year for new U.S. assembled personal vehicles weighing less than 14,000 pounds. That is phased out by income. And the creation of Trump accounts. If we were to just boldly name them after the president, why wouldn't we create an account called the Trump account? I can think of no better name given the status of things in our politics. These are new child savings and investment accounts with one-time $1,000 deposits and $5,000 annual caps. I will have to come back to tax treatment on those. I'm not yet familiar, but there are these new savings accounts and investment accounts for child savings.
Kolkman accounts.
Oh, yeah, that'll be the day. Estate tax exemptions increased to about $14 million per person in 2025, rising to $15 million in 2026. We could talk more about that piece in future weeks in regards to estate planning, which is, drum roll, Chaz, one of the things that we'll actually touch on in the realm of financial planning. When we started this program, I wanted to be hyper intentional about not having another financial planning program that drones on about the same topics that, well, let's just say some of my colleagues who I love tend to talk about the same thing. Okay. And so I have made a point of bringing economics along from my master's work. I've made a point of bringing investment along from 25 years of work, and then also the financial planning aspects. But estate planning is near and dear to my heart. And Chaz, I lost you. That's okay. Welcome back when you're ready. Estate planning is a very unique aspect of financial planning. It is, I would argue, the most comprehensive form of modular planning that you can do. Okay, so it touches all other areas of your life. If you think of everybody having an estate while they're alive and after they're gone, that's exactly how it works. And so estate planning in estate tax terms is referring to, what does the legal community say? Post-mortem, right? After you die, the taxes that are due there. And that's a different tax system than the income tax system. So we can talk about that in future weeks, but a very comprehensive area to deal with. And so I do look forward to that. Chaz, don't fall asleep now. Okay, this is right up there with consistency investing, okay, and tax treatment of dividends, right? Isn't it? Huh? I know. Woo! Okay, so back to the ranch, though. The OBBBA does also raise the SALT deduction cap to $40,000, and then it will likely revert to $10,000. That's, again, back in the income tax front. It also then repeals green energy tax credits. That's EV or electric vehicles, solar, and wind after September 2025. There were a number of other aspects to OBBBA, including healthcare and social programs. Medicaid cuts totaled $1 to $1.2 trillion over 10 years through a number of changes, and also there were some SNAP food stamp changes that increased work requirements and applied state cost sharing. In regards to defense and immigration, the debt ceiling increased by $4 to $5 trillion to prevent default. Defense spending, meanwhile, was up $150 billion, and that includes the Golden Dome missile defense system, naval, AI, and drone programs, drones, nuclear, and Coast Guard. Lots of different aspects of defense spending. Border and ICE funding bumped to 100 to 170 billion through 2029, and that includes a border wall and detention beds, as well as 10,000 new ICE agents and $100 annual asylum fees. Okay, I'm not quite ready to unpack asylum fees here. Student loans, we have caps on student loans. Grad unsubsidized loans max out at $20,000 per year or $100,000 for a lifetime. Professional loans, meanwhile, max at $50,000 per year or $200,000 for a lifetime, and a lifetime total cap then of $257,000. So that's a lot of numbers, but just generally caps on student loans. Restructuring income-driven repayment programs, by the way, that happened. There was this restructuring that paused Biden-era forgiving rules. Okay. So a lot happening with student loans as well. Some things getting restructured or rolled back is the vernacular, and some new things in terms of caps on student loans. Energy and environment was also affected. There was a clean energy rollback, ending IRA-era credits, requiring oil and gas leasing, restoring full drilling deductions, delaying methane fees until 2035, and expanding coal and CCS incentives. The fiscal impact, this bill is estimated to add 2.8 to 4.5 trillion to the deficit over the next decade. And tax cuts do exceed spending cuts by a wide margin, according to multiple sources. And I'll mention Money Week and Kiplinger and USA Facts and a few others. Okay. Markets have really shrugged this off for the most part, including the deficit impact. So just to summarize, in terms of taxes, there are big cuts and deductions for families, seniors, businesses. In terms of healthcare, massive Medicaid reductions, potential coverage loss, actually, for millions, defunding of Planned Parenthood and gender-affirming care. That's a loaded one, I'm sure, in political terms. Safety nets, so SNAP was tightened, work testing got added, and there was a shift of burdening the safety net programs to the states, SNAP especially. And then with defense and border, we had increases in military and ICE funding, new spending on the border wall and asylum fees. And in terms of student loans, we talked about those caps and repayment limits, less forgiveness, energy policy reversing from renewables to fossil fuel, and the fiscal outlook adding trillions to the national debt with a subdued market response. So that's, a lot to say about what happened on July 4th. I'll take a breath. Chaz, I don't have a summary of my own in terms of commentary for this. All I want to do is just say this is what it is, and oh my goodness, it is big. There's a lot here. It's going to be, and just a little foreshadowing, it's going to be really difficult to peg the actual impact or impacts of all of these changes over the next 10 years. So we see, and I'll just preface our second half by saying we see all these efforts at, the Congressional Budget Office thinks this, okay, and these other nonpartisan think tanks think this, and, Senate Republicans think this, and, everybody has their opinion about how this is going to go. So when we come back, we can talk about kind of the history of what goes on with partisan politics as it relates to the economic pattern of expansion and contraction. And then we can also talk about how we might view this in the big picture, as well as much specificity as we can get around impact. So we'll go there as soon as we come back from this break.
Rural Music Fest is back, and this year features Seth Schluter, 22nd through the 24th at Redemption Hill in Isle, Minnesota. Sing along with Sanctus Real. It's the 4th annual Rural Music Fest with bounce houses for the kids, food trucks, raffles and prizes, and music from over 15 Christian artists like Grammy Award winner Dante Bowe. And closing this year's Rural Music Fest, Colton Dixon. It's the Rural Music Fest, August 22nd through the 24th. Learn about camping, volunteering, see the entire lineup, and RSVP for this free event at ruralmusic.org.
Okay, and we're back. So, Chaz, I think you're not asleep yet after all of that information.
No, I'm with
first
you, buddy. I'm with you.
Okay, and I'm glad that you made it through that. I hope our listeners do too. I do think there's a lot of value in going through what this is because, the temptation that we all have is to go with what we hear, down the street or from the media, and it's, really difficult to discern what actually happened unless you're looking at something objectively like we do in this program. So I'll say this. In the past, we've had, the right or the conservatives in politics focus their efforts in terms of policy and lawmaking and, the fiscal side on cut and save. We've had the left or the more progressive end, as you might call it, look at how do we do more tax and spend. Okay. They don't say it that way, but that's the history. We've got 200 years of history in this country of, the conservatives and the right and the left, I'll call it that to avoid any political speak. One saying cut and save, one saying tax and spend. Okay. And, we get somebody new in office, we get a new Congress, and, it's one or the other, one versus the other all over again, basically. So the interesting thing to me about this particular bill, whether it's big or small, but especially because it's big, and I think this is the beef, by the way, with the, I'll pick on Elon Musk because he's so easy to pick on, but the deficit hawks, the people who are really focused on, well, what's the deficit number? Okay. This does appear, and it doesn't just appear, it is cut and spend. Not cut and save, cut and spend. Okay. So where did we cut that? What did we spend? Those are the debates, right? But it's not cut and save. This is not the traditional, politics of the right saying, well, we're going to, cut taxes and cut spending. No. We're going to cut taxes and we're going to spend more. Okay. This is the same thing that happened in 2017. It's actually just piggybacking on that. It's using the tax cut, what was it called? TGGRA, or I forget, 2017 tax cuts that we had. All they did was take this as a baseline, the 2017 cuts, and say, okay, this is our new baseline. In fact, we're going to make this baseline permanent long term. And then we're going to, cut some other things, some of these social programs. We're going to increase some other things like defense and the border wall and so on. And we're actually going to end up spending more than we started with. Okay. In fact, we're going to make sure that we don't have a shutdown of the government. We're going to raise the debt ceiling to do this. Okay. To a deficit hawk, that sounds terrible. And I don't, by the way, agree that cut and spend is a good idea. I don't. In fact, I think that, this is about as political as I get. I mentioned contraction and expansion in the first half of this program, towards the end. In 2017, we were at the end of an economic expansion. Okay. There is not an economist in the United States that I have heard, and I'll say it, qualify it that way, or read, that would suggest to you that tax cuts, which are and they're designed to stimulate the economy, right? That it's a good idea to stimulate the economy with tax cuts at the end of an expansion. Okay, you do that at the end of a contraction. When if you're really into responsible economics, that's when you cut taxes. Okay, that's when Reagan cut taxes. That's when a whole bunch of other conservative administrations went to Congress and said, "Hey, we got to cut taxes," but not this administration. Okay. Now I could get thrown in with the critics and say, "Oh, don't like Trump." I don't care what his name is. I just know it was poor economic policy. Okay. So to do it now makes a little bit more sense from the standpoint that we're not at the end of a long expansion. We've actually got moderating growth in this country and globally. That's been revised downward even since I said that back in March. Okay. So it's a little bit easier to see why we might want some stimulus right now. That makes sense. Okay. We're not talking, emergency stimulus here, by the way, like normal, like things that are going to help us grow for the long run. Okay. Might this bill do that? Yeah, I think it might, actually. So after everything I just said, by the way, tariffs are going to be a drop in the bucket compared to what this bill does in terms of adding or subtracting to the deficit. Okay, so I'll say that, and I wish we had time to unpack that statement, but to say, well, we're going to fill up some of the gap in, the cut and then the spend that's going to add trillions to the deficit that, is on the table and now signed, it's done. Well, tariffs are going to help fill the gap. Okay, billions versus trillions. Let's be clear. All right. So can I go and clip some more coupons on the, the net exports account and GDP, and tax some, quote unquote, tax some other countries for the stuff that we're buying from them or we're selling to them? Sure, we can do that. But that's not going to come close to the amount of, when you're in the hundreds of billions in potential tariff revenues and you're adding 4 to 5 trillion to the national deficit in years ahead, that I'm sorry, I have a hard time taking an argument that tariffs are really going to be this great offset. Okay, and same thing with Doge, by the way. Okay, so hence Elon is so upset. So my comment though is that we get hung up in, I'm trying to drive towards what I actually think here. What I think is that we're actually going to benefit from these tax cuts in the same way that cut and save would. Okay, the idea of stimulating the economy with tax cuts does help bring about growth. So how might this do it? Well, I pulled up, and I'm going to give you one quick example, by the way, of how we don't actually know what's going to happen. And I'll come back to that if we have time. So, but I'll tell you this, I pulled up, Barron's had an article published about 2 years ago. One of the contributors we have to this program, and I were talking offline about, all the attention that the deficit gets, and really the national debt. I'm sorry, I want to be clear about the 2 Ds. So deficit spending is what happens when we spend more than we bring in as a country in a year. That's a deficit or a surplus. Okay, the debt is the amount that's sitting on our balance sheet that we owe. Okay. And so I want to distinguish between those two in my comments. If I haven't done that here, I'm sorry. But a couple of years ago, piggybacking on the Fed's end of 2022 household wealth survey, 2 guys named Paul J. Simcoe and Richard P. Smith published an article and put this commentary into Barron's. So Paul Simcoe is at the time, he was the Frank M. Sands Senior Associate Professor of Business Administration at the University of Virginia School of Business. Okay, and Richard Smith was a director of economics and financial advisory services at a firm in the U.S. Okay, so these guys know what they're talking about, and they came out and they said, look, we're either thinking about the federal debt, and somewhere in that analysis or the headline anyway, where America's headed towards bankruptcy. Right, that's the implication. Or we've generated this high standard of living. We have all this wealth, more than any other country in the history of the world. right? And we hear both narratives, right? So they're picking up on that, much like I'm dealing with every week. So what I like, though, is that they actually illustrated, and this is the conversation I had just a week ago with some a Steward's View participants, is, you know, and I'll ask you, Chaz, if you pull up your balance sheet, okay, and you say, well, here's what I own and what I owe. And let's just pretend you have some debt. Okay, I don't think you have much of any, if I had to guess. But let's say you have some. Okay, and let's say it's troubling you or it's troubling your wife, and you're having this conversation like, oh, this got this debt. Okay. And I'm just going to pick a number. In fact, I'll put it on me instead of you. Okay.
Okay.
So I've got $100,000 in debt. Okay. And I look at the 100,000 and I go, gee whiz, that's more than I make in a year. Okay. And that's the conversation you hear with deficit hawks, right? Yeah. That, well, I can't retire it all in a year. Okay. Yeah. Like that's a concern. Sure.
Yep.
But then what if I come to you and I say, well, gee whiz, I've got 3 times that in assets, right? Or I've got 10 times that in assets, right? What I own.
Yep.
Okay. So I want to add that ownership of American wealth to the conversation about the national debt, right? And I want to do that in a way that helps us think big picture about what this bill is doing. Because just like an American household, One Big Beautiful Bill Act is dealing with national income, right? Like tariffs would be income, okay? And national spending, right? Income and expenses, right? Tax revenues.
Yep.
Safety net programs, whatever. Pick your income and expenses in those items. It's dealing with both of those sides of cash flow, right? And then it's also dealing with, it's impacting, I'll say it that way, it's impacting assets and debts, right? For better or for worse. And the deficit hawks are saying, well, gee whiz, it's going to increase the national debt. Okay, well, yes, but everybody forgets about national assets. And that's why I so appreciated this article. It was straight out of the Fed's 2022 household survey. And here's what it said. It said that the U.S. net worth, and this is over 2 years ago now, at the time was over $135 trillion. Okay, so we get concerned about a $37 trillion national debt. Yes, let's be concerned about that. But then let's go, okay, but what do we own? Not just what do we owe, what do we own? Well, we own 80 at the time. I'm just going to back up in time because there's no more current set of numbers that I could find, okay, that's this specific. Total financial assets, 81.4. It's going to be trillion. And that includes market value of U.S. domestic businesses and U.S. financial claims on the rest of the world. Okay. Non-financial assets, including real estate, durable goods, equipment, inventories, intellectual property, 97 trillion. So that was total assets of, not at the time, I'm rounding, 178 trillion, right? Minus debt. At the time, that debt was $41 trillion. Okay, and that left us with 136 or 7 trillion in net worth. Okay. Those are very healthy numbers. Okay, so does this matter is the question. It doesn't matter as much in politics as it matters in our decisions, right? It's when we make a decision, when we say, well, why is the Treasury market healthy? Why is there demand for U.S. Treasury bonds? And incidentally, we did a series or a couple of shows on U.S. Treasuries and how they behave and foreign countries buying them and what Janet Yellen thought, a couple of months ago. There's been some concern about Treasuries. Okay, so I even put together a program that dealt with the idea that, we needed to lower Treasury yields as this country refinances its debt. I still think that. Okay, the ship's kind of sailed right now, but the point is that Treasuries, only like 6% of Treasuries are currently held by foreign countries. Okay, so I didn't say that in the program that we did. The point is there's a healthy demand for U.S. Treasuries, and that's a good thing, right? Why? Because of what I just said. Why is there healthy demand? Clearly, it's a good thing. But that's because, we have, if I do 180, a couple years ago, 180 versus 41, Chaz, what's 180 divided by 41? 4.4. So we have 4.4 times the asset base that we do the debt base. Okay. Now, what is that number today? I'm looking forward to getting it. I don't have it. I know that the national debt is right around 37 trillion. So I'm really happy to share that, because it gives us a bigger view of, we talk about, all right, well, growth is moderating. This is a stimulating thing that we have going on. Oh, but we might add to the debt. In fact, we're going to add to the debt the way this looks. That's one of the certainties coming out of this whole thing. But, putting that in context, is that going to put our country under? Not anytime soon. Okay, how do I know that? Well, we still have a growing economy. We didn't say our economy wouldn't grow. We didn't say that our companies were all going to go bankrupt at the same time. We didn't say our real estate was going to be worth nothing. Okay, we're just, all we're doing is futzing with the cash flow of this country and then applying it, projecting out 10 years, which is nearly impossible to do, a la artificial intelligence and all the unknowns of what's coming in the next 10 years and the speed of all the changes around us. Come on. Right, Paul Larson, if he was sitting here. So, we don't know how this plays out. That's the point. What we do know is that this is a cut and spend approach to cash flow. That it's expected by any measure to add to the national debt, but that national debt is still, 1 to 4, or assets instead, or 4 to 1, I'll say, of what that debt is. And so I'm highly encouraged by the balance sheet strength of the U.S. economy. And in fact, Paul Larson recently told me, he said, U.S. assets sit around 300 trillion. So we can come back to that. Maybe this number is woefully low today. I haven't been able to find it. So I'll challenge anybody to join us on stewardsview.com or any of our podcast platforms, Amazon, Apple, Spotify, and let's talk about what that number is and where you got it, because I'd like to have it. But I know these numbers from the end of 22, early 23 are accurate. So that's why I'm working with those. The point, though, obviously, is let's not lose sleep over how this bill plays out. Let's just acknowledge it for what it is, which is a cut and spend. It's unusual. It is pretty good to stimulate growth now, in my view, in the sense that we don't have the boom economy that we had when the tax cuts of 2017 were passed, right? However weird that was to say, we got this long, 10-year expansion going on, longest bull market in the history of the U.S. Let's cut taxes. So that didn't make sense back then. This makes a little sense now. Either way, the balance sheet of this country is quite healthy. So I want to continue this conversation as time goes on. Let's pick that up at stewardsview.com. But before we wrap, I promised one example, Chats, of how we don't know that really how this is going to go. Okay, and do you remember, I've asked you about the dot-com boom before. I think you're barely old enough to remember the dot-com boom, yeah?
Barely. I missed it, but I've heard about it. I remember. Yeah, I'm just a little bit too young.
So we ran a surplus then, right? Bill Clinton was in office, and we had this surplus, and it was a big celebration, kind of like a Wall Street IPO. Everybody's clapping, and it was all over, and we had this, this big deal. So, by the way, to those lawmakers who might hear this, I'll just say, feel free to get us into a surplus position. That would be the best possible thing to do. And, but we had that surplus without, the first term, if you think about what happened right before that, the Clinton administration had their first term. They had back-to-back terms, okay? But in the first term, they had this thing called reinventing government, right? Where they actually did more right-style cutting to fiscal policy, right, with Congress. And we ended up with a surplus, only the surplus wasn't expected. Okay, so whether you're doing cut and save, whether you're doing tax and spend, or in this case, cut and spend, we can't say, politics or no politics. We can't say how this plays out. We can only say, sure, this will add something to our national debt through additional deficit spending. We're going to have to raise the debt ceiling, ... What's it going to do to assets? What's it going to do to growth? We don't know. Let's see. Let's see how this goes. I mean, last I checked, we're still the most productive and innovative country in the history of the world. Okay? So I'm going to go with that big picture view of how this plays out and say, I'll borrow Warren Buffett's idea that we don't bet against the American economy. But before we wrap, let's zoom out and take a look at what's coming up this week. Global economies continue to hum along despite the constant barrage of trade tensions and geopolitical conflicts. This week's release of flash PMI data will provide an update on the economic environment for developed nations in the face of ongoing uncertainty. In the U.S., investors will also focus on data such as new and existing home sales, along with durable goods orders. A number of notable companies will report earnings this week, including Alphabet, Tesla, Intel, IBM, Texas Instruments, General Motors, Coca-Cola, and Capital One Financial. Fed Chair Powell is scheduled to speak at a conference on Tuesday morning. While the U.S. dollar has recovered in recent weeks, last week's events demonstrate that pressure from Washington is mounting on the central bank and the greenback. Overseas, the European Central Bank is expected to keep rates unchanged on Thursday, with just one more cut forecasted by year-end. Japan's upper house parliamentary elections over this past weekend may affect their central bank's plans to raise interest rates. Surveys suggest that Prime Minister Ishiba's coalition may lose its majority, giving opposition groups traction to pressure the Bank of Japan into keeping rates low to ease the impact from the country's enormous debt burden. The rest of the international calendar includes minutes from the recent Reserve Bank of Australia meeting, Japan's core CPI reading, and British retail sales. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to connect with us online at astewardsview.com. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.